Today, we are still grappling with the ripple effects of the 2008 financial crisis and the loss of public trust in financial markets and corporations. To deal with this, some shareholders are trying to better align corporate practices with the broader goals of society. This responsible investment movement is growing. Large institutional investors are trying to integrate environmental, social, and governance issues into their investment process. At the same time, they are committing to become more active in their role as shareholders.
Society is asking for more transparency and accountability around the role of boards and CEOs. Shareholders, of course, are not the exception. For instance, the largest public pension fund in the US, CalPERS, has put pressure on the top 60 companies in its portfolio, including Apple, to adopt new voting measures which grant shareholders more voice on corporate matters. Shareholder activism is a global trend that managers cannot ignore. Say-on-pay policies which grant shareholders the right to approve or reject CEO pay packages are being implemented in more and more countries. Since 2011, all public companies in the US have to specify how top executives' compensation relates to performance and submit that to a vote. Critics of say-on-pay argue that such rules will not deliver better performance. They also question whether shareholders are really suited to make well-informed decisions on complex compensation matters. We beg to differ. To determine the impact of such policies, I worked with Vicente Cuñat from the London School of Economics and Maria Guadalupe from INSEAD on a study that looks at US firms that adopted say-on-pay policies before they were mandated by the Dodd-Frank Act. Our results? We found that adopting say-on-pay leads to significant increases in market value of around 4%. Where do these market gains come from? Well, companies that adopted say-on-pay showed $3.5 additional in earnings per share, 5% higher return on asset, and stronger operating return. As well, we found increases in labor productivity and a reduction in overheads and capital expenditures. What about managers, you may ask? Well, surprisingly, the effects of say-on-pay on overall compensation levels are small. There is a slight reduction in salaries and options granted, but no significant effects on total CEO compensation or CEO turnover. Overall, our results suggest that say-on-pay is akin to an annual vote of confidence on the CEO. Shareholders are now empowered since they now have a mechanism to punish poor-performing managers. As a result, firms may deliver more.
Shareholder activism is part of a broader trend. Shareholders are not just becoming more active owners, they're also more careful about the corporations they choose to invest in. Since its launch in 2006, more than 1,200 investors have signed up to the Principle for Responsible Investment. These responsible investors aim to integrate environmental, social, and governance issues into their investment process. They are doing so across all asset classes: equity, bonds, private equity, real estate. They believe that by doing so, they will reduce the risk of their investment portfolio, and at the same time, they will better align their role as investors with the broader concerns of society. Responsible investment is really growing. Look at Europe, skyrocketing from less than $1 billion in 2002 to more than $8 billion a decade later. Today, more than $32 billion in financial assets worldwide are managed by investors who are committing to responsible investment. But is the finance world really changing so fast? Or is responsible investment just a fad? Together with Daniel Beunza from the London School of Economics, we have conducted more than 100 interviews to identify global trends in this industry. We found that, at least for large institutional investors, this trend is real. One of the reasons is that because they own large chunks of the economy, the externalities generated by one corporation in their portfolio, for instance, pollution, might negatively affect profitability in another corporation in their portfolio. Therefore, for them, social and environmental costs can become financial risks. Take climate change. The oil and gas sector has been in the spotlight for years. But now, some investors are wondering whether the market valuation of these companies reflects the price their reserves of fossil fuel will command in the future. As carbon taxes are likely to be introduced to reduce emissions, these reserves will not be worth as much. There are major challenges ahead. To succeed, asset management firms will require a new set of skills. And on the corporate side, the ultimate responsibilities for social and environmental impact will no longer be able to sit solely with Chief Sustainability Officer, but will be increasingly in the hands of Chief Executive Officers. As more investors follow these principles, their impact may go beyond publicly listed companies. Corporations might initially try to avoid this transparency requirement by staying private, but eventually similar transparency requirement will be imposed on private companies too.
Indeed, you see, in the aftermath of the financial crisis, the world wants more transparent and accountable companies. Information is more readily available than ever through social media and collaborative means of communication that facilitate coordination among different parties. Investors have joined the revolution. It is now time for management to engage with shareholders in this new activist environment.